Welcome to the next installment in my lecture series for American Economic History online here at Rutgers University. And in this video lecture, what I'm going to be talking about is the development of the command economy as relates to World War I. And for this section, what I really want you to concentrate on is, number one, the impact of World War I on prices. Anytime I talk about a war that occurs, talk about prices, the deficit, what happens to the money supply, how is the war financed. But also we're going to take a look at elements of the introduction of the command economy, of the government taking greater control over resources in the economy. So that is an example, and some people use World War I as a starting point for the increase in government involvement in the economy, greater government control over economic activity. So some of the things I want you to understand is, as I said previously, the impact of World War I on taxation, how taxes changed, who was taxed, etc. How it impacted government finance, in particular, how did government expenditures and revenues change, the deficit change, the debt change, etc. The impact on inflation, how did the inflation rate change during World War I, and also the impact on wages. Did workers make out better, or were they worse off during World War I? And then we'll talk about elements of the command economy, in particular the Lever Food Control Act, which was used as the vehicle for setting up a host of controls of the economy under the guise that it was of national security interest for the government to have greater control over these resources. And we'll go over them mostly because, as I said previously, it's important to understand that this is the genesis of greater involvement of the government in economic activity. Even though it was temporary for World War I, it's an example of where the government becomes more and more involved in controlling elements of the economy. First, we need to talk about income and revenue for the federal government. So the point we're talking about here is the amendment to the Constitution, the Income Tax Amendment of 1913. So as you should realize that if we're adding an amendment to the Constitution, that obviously it is very important to the legal structure of the United States. So the fact that it was felt that we needed an amendment to the Constitution in order to make the income tax constitutional shows you the importance of the income tax to federal finance. So we'll talk about some of the issues that are related to why the income tax amendment was necessary. All right, if you understand that the federal government needs resources in order to operate. So whether it's controlling resources or whether it's through taxes, the government needs resources in order to operate, whether it needs revenue. So previously, this was achieved through land sales, customs and excise taxes were the main vehicle for revenues for the federal government. Realize that many of these taxes fell upon consumers and they were considered to be regressive. A regressive tax is where poorer individuals pay a greater proportion of their income versus wealthier individuals. For example, if you have somebody who makes $10,000 a year and they pay $1,000 in taxes, they're paying 10% of their income. But if you have a person that's making $100,000 a year and they pay $1,000, they are paying 1%. So the burden falls on consumers, but it has a tendency to be regressive. The burden falls more heavily on poor individuals than it does for wealthier individuals. So the notion was that we needed a tax on economic activity, and economic activity is related to income. GDP is in itself income. Spending becomes income. So realize that if there was a tax on economic activity, i.e. income, it would give the federal government, one, great power over the economy, but two, give it the necessary revenues that it needed in order to maintain its existence. So in order for the government to grow, military, foreign intervention, regulatory functions, etc., what you need is a revenue source in order to support those activities. And if you think about what is taxation, it's just forcible seizure. You make a certain amount of money and a certain portion of it gets taken out of your pay. You don't even get to see that money, right? If you pay state taxes or federal taxes, you have a net paycheck and then you have a gross pay. Net is what you're paid, and the net is less the taxes that you have to pay. So it's a forcible seizure of your income. Now, please note that about taxes, that by default, that if you have an inequitable distribution of wealth, all taxes, any type of tax system is inherently going to be unfair or unequal to certain peoples. The only way that you can have a tax system where it is fair or equal is if everybody starts off with the same level of income. Then if you tax everybody at 20%, the tax burden is the same for everybody. So just realize that under any tax system, if you start out with an inequitable distribution of income, where you have wealthier people and you have poorer people, there are some people who are going to think that this is unfair or the tax system is unequal. That's inherently what's going to occur. Also realize that taxes impact relative prices. If I place a tax on gasoline, I'm raising the price of gasoline relative to other products. So it impacts the way resources are allocated. Once you change relative prices, people engage in substitution. It impacts their behavior. All right, so realize that by placing taxes on certain items and not other items, you're impacting the relative tax, and a substitution effect will occur. Also in the background, that there's constitutional restrictions on taxes, that duties, imposts, and excises shall be uniform throughout the United States. So for example, if you were going to tax imports on beer or wine, you couldn't tax them at a higher level if they were going into New Jersey than versus if they were going into Pennsylvania. So those types of taxes had to be uniform, and that's going to be important in regard to the constitutionality argument that comes up with the income tax. The income tax actually gets instituted during the Civil War and gets re-implemented later on, but there are constitutional arguments against it. In particular, people argue that it is not a uniform tax. That, for example, if you have a progressive tax on somebody, if you charge one person 36%, another person 25%, that is not a uniform tax through the United States. So just realize that the issues and why there was a constitutional amendment put in place was that there were constitutional issues related to this. Some people felt that an income tax was by default unconstitutional. So let's go back to the Civil War. In response to the Civil War, the federal government imposed a tax. All right, and it's progressive because the tax was on 3% on incomes over $800. So if you made less than $800, you paid no tax, and if you made above $800, you paid 3%. So it's progressive in the fact that lower income people have a lower tax burden than higher income people. All right. And then the law was altered in 1862 to make it more progressive in that once incomes reached $10,000, individuals' incomes over $10,000 were taxed at 5%. This tax stayed in place until 1872 when Congress abolished it. In 1881, I want you to realize that initially that the income tax was ruled constitutional originally, that it was not a direct tax, and therefore it was constitutional. That comes from Springer versus the USA. So make sure you realize that initially the fears that the income tax was unconstitutional, it was found in 1881 that the income tax was not a direct tax and was thus constitutional. So make sure you remember that Springer versus US. Particularly in this section, remembering and having just a brief notion of what these different court records, the court findings were. So for Springer versus United States, I would remember that it was not a direct tax, that ruled that income tax was not direct tax and was thus constitutional. In 1894, Congress passed another income tax, But in this instance, 13 years later, after Springer versus the U.S., it was ruled unconstitutional. It was ruled that the income tax was a direct tax, and therefore it was unconstitutional, and that was Pollock versus Farmers and Loan. So make sure you understand the distinction between Springer versus U.S. and Pollock versus Farmers and Loan. So Springer versus U.S. found that the income tax was not a direct tax and thus constitutional, while Pollock versus Farmers and Loan found that the Supreme Court found that the income tax was a direct tax and was therefore unconstitutional. So the Pollock versus Farmers and Loan is why we needed a constitutional amendment to state that it was all right for the federal government to raise revenues through income taxes. All right. So the 16th Amendment, what was the impact? All right, from 1915 to 1919, 53% of revenues collected came from income taxes. So we see a shift away from land sales and tariffs as the main source of revenues for the federal government. And we see that the income taxes become more and more important, that federal revenues are become more and more reliant. So make sure you realize that shift. The shift away from land sales and import taxes for government revenues, and the shift towards income taxes during that time period. Realize that the original tax system had marginal rates starting at 7% and starting at 1% and rose to 7%. So if you had an income over $500,000, you had to pay 7% of your income on that. And also realize there was an exemption of $3,000 on the original income tax. Any money that was made below $3,000 was tax-free. Top rate, take a look at that number. That's not an error. During the war, the top rate was accelerated to 77%. More than 2/3 of income above a certain amount were taxed by the federal government. And then finally, after the war was over, the top rate was reduced to 25%. So I want you to realize how high the top rate was, income tax bracket was for World War II. World War I. 77%. People complain now about a tax rate of 36%. 77% during World War I in order to finance the war effort. I want you to also realize that by changing the tax structure and the ability of the federal government to tax incomes, there was a drastic change to the economy because of that. Let's take a look at the total military expenditures, all right? A dramatic increase, obviously, in wartime. In 1914, military expenditures were roughly $350 million. They rose to $11 billion in 1919. And military expenditures accounted for 25% of gross domestic product. So you can see that how important government expenditures related to the execution of the war was to the economy. Rose to 25% of total GDP during the time period. All right. Realize that income taxes increased. The tax revenues could not keep pace with the additional spending. We did generate additional revenues from the income tax, but it was nowhere near enough to cover the increase in expenditures that were occurring because of the war effort. All right? So what had to happen is, obviously, there's several things that you can do. We talked about this previously. If you're going to fund war effort, you can cut back on other expenditures, you can raise tax revenues, you can borrow, and you can print money. Well, we did raise additional revenues. Those revenues weren't enough. We did borrow money, and we'll talk a little bit about the impact of borrowing, but we also ended up seeing an increase in the money supply and the attendant inflation that occurred because of that increase in the money supply. All right. Also realize, remember, we are operating on a gold standard. with the uncertainties in Europe, and individuals in Europe shipped their gold out of Europe into the U.S. for safekeeping. Since there was an increase in gold flow into the United States, if you increase the amount of gold that's in the United States, this causes the money supply to increase. So I want you to realize that a portion of the increase in the money supply, anytime I talk about the money supply increasing, a portion of that's due to the fact that gold flowed out of Europe because of the uncertainties of the war and into the United States. And with this increase in gold being stored in the United States, caused the money supply to increase. All right. So also we talk about the inflationary nature of debt. And if, for example, if private individuals, if private entities purchased all of the governmental debt, there would be no increase in the money supply. The money supply would be increased, for example, if the Fed or the Treasury Department purchased those, if the Fed, for example, the Federal Reserve Banking System, the Fed system, bought those bonds, because that would cause an increase in the money supply. So if you can manage, the more borrowing you can from private individuals, the lower the inflationary pressures will be, because people are just transferring present spending for future spending. So what you end up doing is that you're just transferring the potential to spend from individuals to the government without increasing the money supply. So be aware of that under wartime financing, the more of the expenditures that you can borrow from individuals, from private individuals, private entities. If, for example, if all of the deficit was financed by private individuals, there would be no increase in the money supply, and there would be no inflation that occurred because of increases in the money supply. And this just gives you some indication of the changes in military expenditures. You can see that the increases were quite small. Obviously, the United States wasn't involved, even though war broke out in 1914, the United States didn't get involved later on. And from these figures, you can see that 1917 military expenditure starts to accelerate slightly, but 1918 and 1919, you can see dramatic increases in military expenditures. Here for the Army, a dramatic increase. You can see for the Navy, dramatic increases in 1918 and 1919. So total military expenditures goes up dramatically. And then also I'll realize that the steep fall off in military expenditures for both the Army and the Navy after peace in 1919, dramatic decreases. So what we want to take a look at is the impact of here in 1918, 1919, what's the impact on the economy of this drastic increase in military expenditures, and then what's the effect in 1920, 21, and 22 when we see dramatic decreases in military expenditures post-World War I. So let's just take a look at generally what happens with federal finance and how that translates to changes in the money supply. Again, you can see the dramatic increase in expenditures for 1918 and 1919. I mean, 1917 we see a gradual increase in expenditures, but then we also see gradual increases in revenues. But notice that revenues by far do not keep pace. All right, you can see the deficit's $850 million here. Then it's $9 billion, and then $13 billion in 1919. So you can see there's a dramatic change in the deficit situation. The government runs dramatic deficits during the last 2 years of World War II when the United States was involved. And you can see what happens to the debt. The debt explodes. We're at $3 billion here. So notice that there's a dramatic increase during this time period of the federal debt. So we do see revenues going up, but they don't keep pace with expenditures, which means the deficit explodes, which means the federal debt explodes. The thing that you should notice is that the money supply does not increase as dramatically as the federal debt or the money supply. So this gives us some, federal debt or expenditures and revenues. You can see that there are some increases, but with this, we can see tenfold increases in expenditures, but we don't see a tenfold increase in the money supply. So this gives us an indication that since we don't see an explosion of the money supply, that a good portion of the deficit was financed through private savings. If we didn't see a lot of this deficit financed by private savings, we would see the money supply increasing dramatically and the attendant inflation that would be associated with that. So let's take a look at what happens with the prices. You can see that prices are relatively stable in the beginning, 1914, 1915. By 1916, wholesale prices increased dramatically. Consumer prices not so. But you can see what happens to wholesale prices during this time period. Wholesale prices increase dramatically, and even up until 1920, wholesale prices keep increasing. So the impact of the war is that wholesale prices and consumer prices increase, that there's inflationary pressures here. The other thing that you should be aware of is that wholesale prices increased faster than consumer prices. All right, if we do take a look at a quick calculation, you will be able to see that wholesale prices increased more dramatically than consumer prices. That the inflation of wholesale prices was greater than the inflation in consumer prices, meaning that the wholesalers and businesses were not able to transfer those wholesale prices off onto consumer. They had to absorb those increased costs in the form of lower profits. Take a look at farm pricing. If you're a farmer during this time period, it's pretty good. If you're a corn farmer, you can see that prices double from 1914 to 1919. So on the farm, this is good. You see a doubling of prices in a span of 5 years. So you end up seeing roughly 14 to 15% of annualized inflation rate for your product. So farmers, and with output being roughly the same during this time period, being relatively unchanged, you can see that farmers are going to be much better off from 1914 to 1919. They're going to see a dramatic increase in revenue, and that's not being that's associated with consistent levels of output. So their incomes are going to increase dramatically. The steel industry, we see the same exact thing. We see steel prices, dollars per gross ton at $30, and by 1918 they had almost doubled also. So you can see that for selected industries, particularly farming and the steel industry, I would think that all farming you would see this. And if we took a look at wheat prices during the time period, these would go up. This would be explained, number one, that there's going to be a decrease in the supply in world markets, that there's going to be a decrease in food production because of the war in Europe. Food production in Europe would have been greatly hampered by this, by the execution of the war. Farmlands would have been destroyed too. You would have had wholesale with people being drafted, individuals would have been taken off the farms in Europe and put in uniform and fighting. So you would have seen a dramatic decrease in the supply of foodstuffs because of the decrease in production in Europe, which would translate to higher world prices. And this would be to the benefit to domestic farmers in the United States. Same thing you could say for Europe. Steel production would be decreased, but also there would be a dramatic increase in the demand for steel. All right, you got to build naval vessels, you got to build cannons, you got to build rifles, etc. So steel prices, there's going to be a decrease in the supply of steel because of disruptions in the European economy. But you're also going to see increases in demand for steel during this time period. So that's why you would see the inflation in prices for steel. How did workers actually do? How did workers make out during World War II? Make sure you realize that the average hours worked declined in manufacturing industries, and this is a start of the average work week declining in the United States. This is a continuation of a trend. It started before World War I, but there was a trend, a downward trend that already existed, and it continued through World War I, where people were working fewer hours per week over time. Also, realize that much of the labor force was taken away for military service. So you see a sharp decline in the supply of workers in the labor force, and with that decline, you see wages increasing. All right? So their wages increased, and they increased faster than inflation. So during World War One, you actually see the purchasing power uh, increase. Real wages, what that is, wages adjusted for inflation, were actually decreasing. And what I mean by adjusted for inflation, for example, if you receive a 10% raise and inflation is 10%, your purchasing power remains the same. Real wages remain constant. But if you receive a 10% raise and an inflation rate is 1%, you see a dramatic increase in your purchasing power. Your real wages have increased. So realize that when I use the phrase real wages, that means your nominal wages adjusted for inflation, taking into account that inflation's eroding a portion of the purchasing power of your income. Um, Nominal and real wages increased during the time period. So your wage rate in terms of how much you got paid per hour, and nominal wages increased faster than real wage than the inflation rate. So this gives you an idea of the trend in average hourly hours worked here. And you can see that there's a downward trend that in 1914, on average, people were working 55 hours a week, and this is reduced to roughly 51 hours per week by 1920. You can see that hourly nominal wages were increasing, roughly doubling from 1914 to 1922. And you can see this translated to about roughly a 20% increase in real earnings, a 20% increase in the purchasing power of workers in the manufacturing industries. Here, I just want you to be aware of what happened with interest rates, and this is interesting to me, particularly. It's sort of counterintuitive why interest rates, particularly the prime interest rate, would fall at the beginning here. And the rationale, that the explanation for this, is that the wartime economy really didn't kick in with the United States until 1917. So we really need to take a look at what happened to interest rates from in the period of 1914, 15, and 16 to 1917, 18, and 19. You can see that from 1916 that there was an increase in interest rates. So given the fact that there was increased demand for funds from the federal government, the expectation would be that interest rates would go up. Let's see what we see for bond rates, 1916 to 1917, 1818, and 1819. We see a trend of bond rates going up, so an upward trend of interest rates in both the prime market and the bond market. What do we see for common stocks? Common stocks, the rate of return on common stocks is much higher. So we see that the stock market and companies that were engaging in business during the war, what do we end up seeing? We see that they are doing better. And obviously, if you're a company in manufacturing and you're producing more, what happens? The stock yields during the latter part of World War I saw a dramatic increase. All right, let's take a look at the inflation rate. Remember, I told you that we take a look at 1914 and 15 when the United States wasn't really involved, and then we take a look at 1916, 17, 18, and 19. A 1% inflation rate, then an 8%, then 17, then 18. So you can see that there's a dramatic increase in the inflation rate. It's something that you will always see in wartime because the government is demanding additional resources from the economy. And as it's demanding more goods and services, it's going to push prices upward. So there should have been, as our expectation, as the wartime economy started to ratchet upward in 16, 17, and 18, our expectation is that we will see higher levels of inflation occurring during that portion of World War I. Now, we also have to talk about the command economy because the government needs resources in order to execute the war. So it has to exercise greater control over the markets. And the federal government could not respond simply on markets for the wartime economy. All right, it was deemed in the government's rationale and Congress's rationale that it was in the national economic interest, national security interest, that the government have greater control over the economy. So they did adopt a lot of non-market control devices. During this time period, over 5,000 governmental agencies were created while we were executing and the executing World War One. While we were fighting World War One, there was a whole plethora of new governmental agencies that were put into place. So the government needed these, the justification for this, the government needed these because of the fact that it needed these resources and it needed to get those resources to build the army, to help feed their allies in Europe, etc. And it was irrelevant to them who was adversely affected by this allocation of resources, whether prices went up for certain individuals or other individuals couldn't get certain commodities. That was irrelevant because the government and Congress deemed it necessary to take these allocations of resources and allocate them to the government and away from private individuals. And here's an example. If you draft somebody into the Army, you're allocating resources, right? You're taking resources. You're forcing somebody to join the Army, the Navy, or the Marines, or the Air Force. I guess the Air Force didn't exist back then. And realize that you're taking an allocation and you're making an individual contribute, and you're paying them below their opportunity cost. So, for example, if you have somebody who's making, back then, $500 a year, let's say. If you draft them in the Army and pay them $100 a year, you're not compensating them for that $400 difference. So you're forcing the individual into an occupation that they don't want to have, and then you're paying them below the opportunity cost, so you're actually making that individual worse off. So that's one means that a government can get the resources it needs by drafting individuals. Also, I want to give you a notion of a couple of boards and administrations that came into existence. The Naval Consulting Board, all right, make sure you realize what the Naval Consulting Board. It was set up to evaluate national defense needs, and it was eventually converted to the Council on National Defense. This was very important because it laid plans out for controlling food supply and controlling food prices, the allocation of resources to different industries, making sure, for example, that enough steel went to the industries that were building naval vessels, making sure enough steel went to the industries that were going to make tanks and were going to make rifles, etc. All right, making sure that the top priority was the production of goods to prosecute the war. In order to fight the war, certain resources and material were needed, and the Council on National Defense was set up to make sure that the industries that needed those resources got those resources. It also was set up to control food, and it also had elements to censor the press. A lot of people don't realize that a portion of what happened in World War I was that there was an element of press censorship that existed during World War I. Also realize the Shipping Act. It organized the Merchant Marine. It was controlled by the U.S. Shipping Board. This is important because if you realize if we're fighting the war in Europe, we've got to get men, material, food, guns, cannons, tanks, airplanes, whatever you need have to be shipped over to Europe. So you have to organize a merchant fleet in order to move the resources from the United States and over to Europe. So the Shipping Act was very important. It introduced an element of governmental control over the merchant marine shipping fleet. The Lever Food Control Act is the main act that you should be aware of. This had many, many elements in it. It was the primary piece of the control legislation that the government used. All right, gave the government the license to federally licensed businesses. So in order to do business, you had to be licensed by the federal government. And that gave the government control. If you couldn't get a federal license, you couldn't do that type of business. Also, the threat of having your license revoked is a very powerful license. If your license is revoked, you cannot do that type of business anymore. So you might think that licensing is a very small component of control, but in essence, it gives you total control. If you refuse to license somebody, they can't do business. And if you threaten to take their license away, they can no longer do business. So the ability to license companies is a very important component of governmental control. Also, requisitioning commodities. Instead of letting the free market determine where goods are going to flow to, the government could just step in and say, no, we're taking those things and we're paying you X amount. So requisitioning, for example, as the draft is requisitioning labor, the government can also engage in requisitioning commodities, food, steel, etc. And also the Leader Food Control Act allowed for the direct control of business. As a matter of fact, during World War I, the federal government nationalized the railroads. The railroads were deemed so important to the movement of troops, food, and material in order to fight the war over in Europe, all right, that it was deemed essential to the prosecution of the war, all right? And it was essential to do that, so therefore the government had the domain, and it was perfectly legal to, under their understanding of the Constitution, that the nationalization of the railroads, that the federal government physically taking the railroads over during World War I was legal during that time period. All right. It also gave the power to establish minimum prices for wheat and other crops. So it actually put price floors on wheats and other crops, which doesn't make a lot of sense because in a wartime period, generally what you end up seeing is prices going up anyway. So setting in a minimum floor for wheat and other price floor for particular products doesn't make a lot of sense, but it's another element that the government could control the allocation of resources by controlling prices in markets. They controlled fuel supplies, they determined what was going to be produced, they fixed coal prices, etc. The U.S. Fuel Administration fixed coal prices, didn't allow coal prices to rise so much. All right. Also, they set up the War Industries Board, set up production priorities. Obviously, you have different resources that are needed in different industries. It set up the production priorities. Who needed steel more? Was it more important to build ships, or was it more important to build tanks? It also fixed prices for those inputs. And it also was set up to coordinate government purchases to try and make this control mechanism that much more efficient. All right. The War Industries Board governed contracts. All right. And it set its own criteria for war production. Also, launched a campaign to standardize industrial sizes. So basically, the government was standardizing drill bits and clothing down to a specific item. So you can see how more and more the government is creeping into the operation of the marketplace under the Leader Food Control Act. The U.S. Grain Corporation bought food and other commodities to fix prices. So the government was trying to fix prices to try and keep inflation from accelerating during this time period. Remember what I told you is during any war, inflationary pressures build up. So you end up seeing commodity prices going up during a war. And what these boards and the Grain Corporation specifically was trying to prevent hyperinflation or excessive inflation of these different commodities. All right, the Housing Corporation. All right, because there was a dramatic increase in the number of defense workers, it was set up to actually create housing for defense workers for specific industries. And the Emergency Fleet Corporation organized shipyards and materials and helped to build ships necessary for the war effort.